Televoo, how are you? Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of helping you plan your trades in advance, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Wow, is it Thursday? Holy smokes. Thank you for being here. My name is Wayne McDonald. I'm a currency trader. Hey, it's the economy. And I guess you can't read that. That's all. Just the economy, huh? Yeah, so life is interesting. So we will go through the charts today. Gold, oil, and Bitcoin I think we should look at. Dollar pairs, yen pairs. If you want to do a cross pair, you let me know. We'll even look at the stock markets. Probably start with that. So let me know how it can help. Technical analysis, fundamental analysis, trader psychology. It's all fair game. Been doing this for 20 years and I've made more mistakes than you. Probably. So, yeah. Louis says yen crosses. Yeah, sure, buddy. So you let Uncle Wayne know how to help, and I will do my best to serve. I am a humble servant. So thank you for being part of that community. If you could, if it's not too much trouble, would you please click the thumbs up button and let YouTube know that this is quality content? I'm trying my best, Bubba. That being said, there are many resources besides these free live streams. If you look at the description below, there's a link to my book, Strategic and Tactical Forex Trading. There's a link to my education service and community called FX Bootcamp. The link is down there. Hey man, it's $88 a year. Hey, that's pretty affordable. Cool, there's a link to QuantBox, which is a macroeconomic quant in a box, doing all your macroeconomic work for you automatically. So you can do it yourself. And in fact, I believe in the description below, there's a link to an hour-and-a-half webinar on how to do all the quantitative fundamental analysis for free, what to look at, where to get the information, how to do it. So that's a great, maybe you want to take that course. It's free. And then at the end, I say, oh, well, you can automate the whole process too. So I think it's a fun presentation. Anyways, I digress. There's a link to tradersway.com, a trustworthy, ethical foreign exchange broker that actually enters your trades into the interbanking system and doesn't trade against you. Well, hell's bells. Yeah, that's good. That's a good thing. They actually pay you your swaps. That's also a good thing. So tradersway.com. And there's probably a few other things in that description. So take a look. Take a look. Let's, first of all, let's see. Did you answer the poll? Yes, you did. Let's take a look. 50% of people say they're trading euro dollar. And if you're using QuantBox, you might notice that, well, euro dollar is here. So quantitatively, you would expect this to be down, and it is down. And it is down a fair bit. So QB was correct. QuantBox was correct. It did the right thing. But look at this. Bitcoin is way up here. Holy smokes. Now that is an outlier, which is interesting. Okay, how about this? The Japanese stock markets still go cray-cray. And actually all the stock markets are up right now. Oh my God. It's kind of strange that we were not getting that a couple of days ago. So if we look at the heat map, it's the same thing, but just done differently. You can see the biggest loser is gold, and pound dollar's way down there, Aussie dollar's way down there, euro dollar's way down there. Okay. Now the difference between this and the scatter plot is the scatter plot shows what you would have expected quantitatively. This just shows you what has happened. It doesn't tell you that, you know, pound dollar's down and it should be down. It just tells you it is down. The scatter plot is better, in my opinion, because you can see these assets were expected to be down, and they are down. These assets were expected to be up, and they are up. Like for example, okay, here's the Nikkei. Look at this. Everything says up on the Nikkei, except retail traders. They're short. But anyways, look, this isn't anything new. You can see the Nikkei is way bullish. And then you look here, and of course it has performed. This is real time. So it's way up, and of course it was expected to be up. And you can look at the historical back test, and we can pull up the Japanese stock market right here. Come on now. Come on, bub. There we go. Okay. And it's been bullish since February. And so now to see how that actually looks on a currency chart, or on a chart, I should say, you go here and holy smokes. And of course, QuantBox said, well, not said, analysis of quantitative data said around that sort of February to March period, which is a little left actually, this period here, it said quantitatively expect some up. Expect some up. Up. Well, you can see it wasn't going up yet. It would have had a lower score. In fact, it did have a lower score. But then it did break to the upside, and it got better. So that's kind of how you use QuantBox for those that are using QuantBox. Let me bring it back. You can see it had a low buy score even during the down, right? Neutral. Like, what is this? 11111111000000000, which is neutral. And then look at this. 22222 111111 22333333333, right? And then spiked all the way up to very, very, very strong. And that's translated with that from buy it, neutral, buy it, really get going, go. Anyways, that's how you use it. Okay. Mikhailovich says, hey, good morning, Wayne. I haven't caught you live in a long time, but thank you so much for your energy. And oh, my pleasure, man. Every freaking day. Yeah. I appreciate that, man. Yeah, I do. Because I'm tired. Yeah. So thank you for what you do. That water is so good. So anyways, Nikkei, Oscar, Mike. What else is going on? S&P 500 had that big rally up day and is still there. And now I'm concerned. Anyways, this is up. Everything is up. And earlier this week, I had positioned things as if they would fall. So let's go check my trades because I was buying the US dollar, and typically you wouldn't do well if all those stock markets are up. Well, I decided last night to stay short euro dollar with the blessing of the rest of the day trading group. Let me get rid of that. I asked everybody because we were here, and I said, should I panic or should I stay short? Okay. So Davey says, how do I feel about Dixie? Well, this is me trading Dixie, right? I'm not actually selling euro, I'm buying dollar. So it's mentally the Dixie. So I stayed short and made the right decision. In fact, I added a second trade. So that trade I can now move to break even, and now I have one trade at break even, one trade. I'll move this down with 30 pips profit locked in. Okay, great. Well, look at Kitty Cat, and I've stayed away from Kitty Cat, and I'm so happy I did that. Look at this. Oh my God. Oh my God. I stayed away, didn't trade this one, and I'm so happy. And at the time, it just didn't make sense technically or fundamentally, so I stayed away, and that was a good choice. Looking at Aussie, no, Euro, we just did this. Why is it out of order? I guess I didn't do Aussie. Okay, let's take a look at Aussie, back this out a little bit. Okay, so I stayed short Aussie. It's down, but it hasn't made a lower low. That allows me to move my stop. So I'll move it from basically break even, and I'll lock in, it's not a lot of pips, 25 pips profit here. I guess I could do 30, just like the other one. So I got 30 pips locked in on that one, but no lower low, so I'm vulnerable on this chart. Remember, the decision was, should I take profit last night or let it go? And that one hasn't really, it's neither here nor there. It didn't fall, but it didn't rise. So I did better on the euro. We'll look at the pound. I have 2 trades on this one now. So I added last night. So I'll move that to break even, and I'll move this one down. I can only grab 20 pips out of that. So these are tiny, pissy little trades. But nonetheless, okay. Nonetheless, so I stayed short last night and in fact added one. So now, once again, not a real lower low. And all the stock markets are up, and that would be nasty for a trade like this. So it looks like we're risk on in the moment, but I'm set as risk off. Okay. Oh, you're watching from Jamaica? I love Jamaica. I've never actually been there, but I would love me there. Okay. So anywho, I'm going to switch around now. So that's that. And then Kiwi dollar. I was short this earlier in the week. The plan on Sunday was have it come up and sell it, which I did. And it dropped, and then it knocked me out, and then it's moved sideways. So I'm glad I'm not in it. Okay, I'm glad I'm not in it, and that's that. That's all. I gave it a shot. And then we look at the yen. And the yen is just slightly breaching the top. Last night in the day trading group, I suggested the plan was, if it makes a higher high, buy the dip, and that might be giving you your entry if you're going to try it. You might have that during the New York session. Oops. And it hasn't done much, so I'm still, let's see, I guess I can move my stop from break even. That's 300 pips right here. No, I'll move it down. Okay, that's right here, 200 and... There we go. So that is 300 pips locked in right there. My worst case scenario. 300, man, 300. Cool. So anyways, that's that, because in the scenario of a potential double top, you know there could be profit taking and we come back down, in which I might even lock in some more profit. But what we're hoping is we have a breakout, pullback, and continuation following the Nikkei, the Japanese stock market. Okay, so let's see, am I missing anything? So yesterday I had 400 pips profit, now I have 550. So 150 pips overnight. Cool. Okay. Do you think euro dollar going to 107? Do I think? No, I don't think. I'm a supermodel, dude. Don't ask me what I think. Okay. So, what is the projected low? Richard. Now, Louis says, Wayne, I think the S&P 500 should rally after the debt limit is passed. Yeah. Then the stock market would correct. Do you agree? That is very plausible. A debt limit agreement? Yeah, that would be a relief rally. The thing is, what if we don't get it this week? I said earlier that it would happen on Friday, and then I said last night, what I meant by Friday was like 11:30 at night, well after the stock market is closed. So that maybe the stock market closes low on Friday because no agreement is reached. Okay? And then there is one, and then there's that, and then, I think the biggest potential isn't the debt limit per se, although it will probably create a relief rally. I think the market is so heavily positioned for a Fed pause, and yet many of the Fed officials, when you listen to them, they are very clear that they haven't made that decision. And like Bostic, for example, or the new one, Goldberg, or what's his name, they're like, dude, I would even raise interest rates. They're actually saying that. And that's not priced in. I think that would be the biggest shock if the Fed actually raises interest rates in the June meeting. That's not priced in. It was 0%, and now I think it's close to 25%. But anyways, that creates dollar strength, and that's one major reason I'm long the buck. Okay? So anyways, Richard, I asked you what the target was. He didn't respond. She said 107.50. 107.50. Yeah, that's a conservative target. 107.46 and a half. That's what I got, somewhere in there. Yeah. So it's not what I think. It's the pattern. Monthly M3 to monthly M1 is the pattern. I don't think that. That's not what I think. What I think is irrelevant. I could be wrong. You're listening to a YouTube live streamer. Jesus criminy. You would never ask them what their opinion is. Okay? You should ask your other live streamers, like, have they ever been licensed and registered? Have they ever traded $1 billion in a month? Have you actually passed the Series 3 exam? Huh? No. Have you had FBI background checks? I've probably had the FBI check my background probably 5 or 6 times over the years. Huh? So anyways, don't ask me what I think. I'm a YouTuber, for crying out loud. But what the chart says is if you enter here, then you exit here conservatively, right? Right on, RS. Ba 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 ba. Wouldn't it be cool if one day you just had to have regulation? You had to have a minimum requirement to be a live streamer and talk about finance? What do you think would happen to you on YouTube if YouTube suddenly said, if you're going to talk about trading stocks, you have to have a Series 7. If you're going to talk about trading Forex, you have to have a Series 3. Jim, you're running into a newbie. It's not bad, but it is a newbie issue. You were waiting for it to touch the 21, right? Think of it this way, Jim. You're out in the woods and you're hunting. And you come across a deer. And you freeze in your tracks and it freezes in its tracks. And there's a pause. And then, boom! He takes off, running from right to left as fast as he can. He's running for his life. So you aim right at the deer and you shoot it in the ass. No, that's just horrible. Horrible. Why did you shoot it in the ass, Jim? Now, big fella says rigs are destroying the world. Yeah, I get you, big fella, but also I think unqualified people are destroying the world too. I mean, I got something pop up on YouTube just yesterday. I think it was one of these little record things with your cell phone. What do they call them? Stories or something. And it popped up and it was just some kid. He's like, look at me. I'm making $12,000. I'm trading the FOMC thing. And it's showing him second by second. Oh, I'm up 3,000. I'm up 5,000. I'm up 7,000. And it's horrible. And you're looking at it like, dude, how many freaking lots do you have? Because you can see he's only making tiny amounts of pips. He's only up 20 pips and he's making $2,000. And I'm like, dude, it's so destructive. So bad, right? It's cancerous to the community. You're like, But then you tell the guy, well, you need to go and get licensed and registered. That'll probably cost you about $10,000. Then you're going to have to pass the Series 3 and the Series 34. And then to be a professional, right, which now will take 3 or 4 or 5 months of study. And you actually have to pass the test. Minimum is 70%. To pass the test, and more than 50% of people fail the test, so it's a hard test. So you're going to have to do that. And then to become a money manager, you're going to have to probably spend about $30,000 in legal documents and set up like your disaster recovery, your disclosure document, your all these different memorandums. I've forgotten how many there are. And then you have to have $65,000 in net capital requirement just to now start your Forex trading business. And they say, well, I can't do any of that. And then I'm like, well, you shouldn't be on YouTube. Right? So big fella said, yeah, you'll miss free speech. Well, there should be like limitations on that kind of free speech where you say, investing money maybe should have some level of rules of engagement. But if you want to talk about other things, maybe they have less requirements, right? Yeah, so yeah, it's tough. It's a tough line, big fella. One of the things I really, really like about the world that we have now is podcasts. It's fantastic that you can listen to a bunch of podcasts and get your news because, compared to like, I only watch finance stuff. So when I do watch Bloomberg and CNBC from time to time, and they're okay, they're good. But if you're banging around between CNN and Fox and some of the other choices, by and large, if you haven't watched it in a long time, if you haven't logged in to either of those channels, it's close to garbage because it's so purposely biased and the news is supposed to be unbiased. So it's no longer news, it's entertainment, and it's dangerous and maybe even hurtful. So I look at it and I'm like, oh my God, that's horrible. But then you can move away and just listen to podcasts and get fantastic information. So a buddy of mine was talking about how he loves Tesla and Elon Musk. And there's like podcasts that he listens to every day where people are covering Tesla every day. They have someone to interview, something to talk about. And you're just getting all this really cool deep inside information about Tesla, because that's what interests him. And it's really, really amazing content. And I appreciate that in our world, right? Okay. But yeah, so, right? Yeah. So anyways, yeah. So anyway, Euro is generally strong and heading up, and CAD is now heading back up and is at a good time. So if you look at a smaller time frame, let's go into here. Okay. Euro strong and CAD strong. So somebody was asking me to cover Euro CAD. No. Why the heck would you want to cover that? Maybe for tomorrow, right? So where are we? So we can go to the dashboard and let's just look at crosses only. Oops. Okay. Crosses only. And, so by the way, I have some ideas on how to make this even better, just so you know. So you're like, it's hard to read. It is hard to read. Euro pound, Euro Aussie, Euro CAD is about, I mean, it's expected to be kind of, I don't know. It's not that interesting. Okay, you know what I mean? Richard's doing CFA. That's really nice. Right? All that is finance focused, which is great. It's not economics, it is finance. It'd be very helpful, in particular, in some form of quantitative analysis. Not really, like QuantBox is economics. Finance would be like one of the things I was thinking about even just this morning is doing a course on bonds. And you'd have to do bond math, wouldn't you? And a CFA not only could do the bond math, but could analyze the convexity of the yield curve or something, right? But so you would start with, what are bonds? How are bonds different from stocks? Then you'd have to go into the bond math of why price and yield are inversely related. And then you'd cover a bunch of, that kind of math. But then you'd want to cover the yield curve and monetary policy. But then you'd want to cover spread like TED spread or 2 10s, 2 5s. You could put a lot into that type of course. And all of that would be basic. And a CFA could go heavier into the math side, right? Much mathier than that. But it seems to me it wouldn't be a sexy course. I think most people wouldn't find bonds and doing bond math and doing yield curve analysis would be a fun, sexy thing, but it's how money is made. And really, we have to understand the vast majority of what we trade in Forex is influenced by bond markets. When money is moving from one country to another, yes, some of it is tourists, some of it is business investment, foreign direct investment. Some of it is just moving capital around to pay taxes and pay bills. But a lot of it is like what we're seeing in Japan now. The reason that this yen is so weak is money is flowing from Japan into the United States to plausibly purchase treasuries, which are just government bonds. Why would they want to do that? Well, the central bank of Japan is weakening the currency, so you don't want to hold it. You want to get rid of it. You want to convert it into something. How about the reserve currency? But beyond it being the reserve currency, it also is a high yield. And so really what might be going on to explain that is the bond market, the treasury market to be more specific. The treasury market to be more specific, huh? So it'd be nice to understand that, huh? Okay. Now, it's not necessarily true that that's happening. So we got to be careful because if that were true, the yield on the 10-year T-note would be falling. And we were at 3.48, I think a week ago. And now we're at 3.58. So it's not necessarily true that that's happening, that the dollar might be strong for other reasons. It doesn't look like foreigners are buying U.S. treasuries. I think that's going to change. So we're in a bearish market right now, but by bearish, I mean price. So if this yield is going up like it is, you can see it's projected to head as high as, the best case scenario over the next week is that we go from 3.58 to 3.72. Base case is we're still at this price, so there's a dip and a resumption. Again, this is if the rise over the run maintains the same slope. Okay. But what that means is the bond market is falling. Okay. I have a suspicion that somewhere in the near future, if this goes all the way to 7.2 and we're getting closer and closer to 4.0, remember that means the bond market's falling. I think if I was an institutional investor, I'd buy a lot of that 10-year T-note at 4%. Okay. Because I would believe that although I think inflation is not going to permanently fall, I think it's going to fall below 5%. And we're at 4.9, as you know. Okay, so imagine in a year, inflation's at 3.9 and your 10-year investment is at 3.9. So at least in real terms, you're neutral in the market, but you're also guaranteed an income. Okay. You can see institutional investors are short. Okay, which means they believe interest rates are going up. Yields are going up. Okay. Darko says maybe not flowing to the U.S., but also in the EU market. Right. Well, I think that is true, Darko, that money is going to move toward Europe because I believe the word on the street is that the ECB is going to need to get significantly more aggressive and that they're going to have to raise a lot higher than they were thinking. Madame Lagarde is going to have to become more hawkish. And if the Fed pauses, then what we want to look at is the rate of change, not the absolute differential. So if the Fed pauses, let's say at 5.5, so let's say the Fed raises one more time and then sticks, right? Okay, the Fed is at 5.5. The ECB is nowhere near that. But the ECB would be in a policy of continuing to raise, even though it's lower than the United States. And the United States is in a new policy of not raising. The relative change now might favor, on the short run, euro, because, again, you're like, well, the carry trade would favor the US dollar. Yes, it would. That would be for the carry trade, which is an income-based strategy. But for the asset appreciation strategy, euro would probably catch new flows where the dollar would not catch new flows, because those people would have already bought their 1 year, 2 year, 3 year, 5 year, 10-year notes, because that's why they bought the dollar, right? And so now the rate of change in interest rates would create an asset appreciation strategy that would favor the euro on the shorter term, right? Right? So that would probably work for a while, and then it probably would unwork for a while. Also, it really matters what happens globally, and we need to think on a global scale to be Forex traders. So Europe might be raising interest rates, but if we're in a global recession 6 months from now, money's just going to flow to the reserve currency. And Europe might be doing everything right, but all the money is going to go to the US, including European money. In particular, the Dutch, because what will probably happen is Italy will get in trouble, Germany will scream bloody murder, and the Dutch will have to bail everybody out. Right? Everybody says the Germans bail out the Greeks and the Italians. I'm like, no, I think it's the Dutch. So anyways, the Dutch are probably getting all their money out of Europe as fast as possible so they can say, well, we don't have any money. We can't bail you out. Okay. Now, I had some news somewhere I want to talk about, and it's hard for me because I don't remember what it was. Dust in the wind. Not that page. Oh, too many windows open up. All we know is dust in the wind. Maybe here. Yeah, I think it's this one. All right, so hang on. Let me load. No, not that one. Not that one. I think it was this one. U.S. commercial real estate prices fell in the first quarter for the first time in more than a decade, according to Bloomberg, risking more banking stress given that lenders owned over 60% of the $3.6 trillion in outstanding commercial real estate loans. Wait, translate that. All right, when you go to buy a skyscraper in downtown, you raise money. Okay, you raise money. And the most a bank will put in is 70%, usually, right? So now you might be more familiar with buying a home. You decide you want to buy a home, and then you go to a bank and you get a mortgage, and they're like, well, you have to put 20% down, right? So the bank ponies up 80% of the money. In commercial real estate, you're not going to get that. You're going to have to put more like 30% down. Okay? And the bank ponies up the other 70%. Well, over time, there's amortization and a few other things. Or because of stresses in that market, they might be saying, you need to put in 40%. We only have to put 60% in. So typically what you do is then you syndicate and you put in some money yourself. You go and you bring in some outside investors, and together the syndicate puts in 40% of the money. Then you bring in the bank, they put in 60, and now you got yourself a skyscraper. So that's how you get to the 60, either through amortization or some form of syndication, which is just a way to leverage. or you actually put up the 40% of your cash. Okay. It's usually not done that way, but it could be. Okay. So anyways, so banks own 60% of this $4 trillion market. And by market, I mean, well, there's actually 3.6 trillion in mortgages on skyscrapers and apartment buildings. Okay. Uche says, hey, why the bullishness of the Dixie? Watch yesterday's video, or the one from the day before, or the one from the day before, or the one from the day before, or one from the day before. Okay, nothing's changed, my friend. It's macro. It has to do with risk analysis. Anyways, so check this out. So this was reported by Bloomberg that, again, U.S. commercial real estate prices fell for the first time in 10 years. I have a deal for you if you want to put in some money. Okay. In the New York area, you can buy some office buildings. Okay, it's probably in Manhattan and near Manhattan. The price not long ago was $733 million to buy the property with a net operating income of $50 million a year. Occupancy rate is 91%. Okay, the mortgage is $440 million. Okay, the interest rate on the mortgage is $5 million. Should you buy it? Okay. I'll give you the information. Okay, you should come up with a value. Should you pay $733 million for this? Thank you, Alan. Now, how many people are interested in this type of information where I give you these numbers and you tell me exactly to the penny what you'd be willing to pay? How many people are interested in that kind of investing? Time value of money? Yeah, well, that's going to be part of it, right? Now, the problem is you guys are probably pretty good real estate investors already, so I don't know if you know this stuff already. Okay, so how much profit is in this trade? If you, okay. Is this a profitable investment? Well, how much is the mortgage every year? Roughly speaking. Let's do cocktail napkin math. Yeah, a friend of mine bought skyscrapers in Germany and in Poland. Yes, all for payment. Right, but look, if it was 10%, okay, you'd pay $43 million a year. Okay? So let's just dumb it down. Let's say it's $25 million a year. So they're telling you right now you would make $25 million a year profit by assuming their mortgages. It's an assumable mortgage, so it's already financed. What they're not telling you, though, is sometime soon you're going to have to roll over those mortgages at probably an interest rate significantly higher. Okay? So what if you had to roll it over at 7.5? Uh-oh, if it's 7.5, you're getting almost break even, right? So let's say it goes from 25 million to 40 million. So now if your occupancy rate drops, you're not going to make any money on this deal. Okay? Or here's the other big problem. Let's say in 1 year, this assumable mortgage rolls over and you have to get new mortgages, and they write down the value of your property, okay, down to 440 million, 450 million. Because remember, it was supposed to be worth more than that. What's the problem? Well, the problem is they're asking 733 million. Okay? So, whoa, dude. Whoa. What do you mean? Would you pay $733 million to assume a $440 million mortgage? What happens if they roll it over and they say it's not worth $733 million? Okay? What if they say it's dropped to $440 million and now they only want to give you 60 cents on the dollar? So now they're only going to give you $350 million. So they're going to say, all right, well, you paid $733 million, but for us to refinance this, you're going to have to put in another $100 million. So now you're really paying for it today, $850 million. Because what is it possible property values in commercial real estate fall? Well, according to Bloomberg, they just fell. So this deal a few months ago was $733 million. Today, they are asking $570 M. What do you think of that? My guess, and I would have to do the math, and I'd have to do some risk analysis, and I can tell you it's probably the wrong time of the cycle to be making this purchase. So I don't even really want to do the math, but I'm trying to show you that they didn't give up $150 million because they are being kind. Okay, my guess is it's not even worth $570 million. At the bare minimum, you would say it's only worth 438. It's only worth what the mortgage is left. But the thing is, if the property value keeps falling, like what they're doing is dropping the property value, then when you roll over and get a new mortgage, they're going to tell you it's worth less than that. They don't want to put 440 back into it. because of risks in the market and trends in the market. Like everybody wants to work at home. They don't want to work in a skyscraper in downtown Manhattan. And if you do work in Manhattan, you don't want to work downtown. You want to work midtown. So like there's just low demand. So your occupancy rate will probably drop. The property value will probably drop. So your investors don't want to put that kind of money back into a sinking ship. So now they'll only give you a $300 million mortgage. So even if you bought it for 438 and gave no upside profit, all you did was assume the existing mortgage. Well, the value of that will probably cost you at least $100 million. But of course, interest rates will probably be higher. So now it'll cost you more, and you're right. Well, your NOI would stay the same if your occupancy rate stays the same, but your cost of financing goes up. So now, once again, you're kind of screwed. So what I would do is I would wait another year, okay, and offer, 275 M. And these guys cannot imagine it. They're like, oh my God, we were asking for $750 million. Yeah, well, 1 year from now, they're the ones that are going to have to take the loss or face the rollover. So here's the thing. They face the rollover 1 year from now and they have to refinance. Not only do they get no asset appreciation because the property value has fallen by 50% because nobody wants to work in these buildings anymore, but the bank says for you to just keep the mortgage, you will have to come up with $150 million cash. What's the likelihood these guys don't have $150 million in cash? Okay, so now the bank is like $275 million, right? Whatever, and then you come in and you buy it. So those numbers don't quite work out, but I think you know what I mean, where they have to face a paper loss or an actual cash investment. And if you don't have the cash, you take the paper loss. Why is gold going down? Because dollar's up. Okay. Cool. And you're like, but these rallies. Okay. Well, one of the things I was telling you about, I think it was just yesterday, that I think any upward move right now in the stock market is just hedges coming out. I said, just because it's going up doesn't mean people are buying it. So think of it that way, where hedges are being removed, but no real cash flows. And so people are doing what they want to do. So anyways, gold is way down. As you know, I'm a bear on gold. The big X is the giant take profit zone. And the big X here shows that there's still quite a bit of potential in the next 3 to 5 days for this to rally back up. Thank you, Favor. Jim says, family money moving from gold to equities. Well, depends on what you mean by family money, obviously. But, the way I think of family money, I'm not sure what you mean by it, but, I think of an average person that puts in $500 a month in their 401k. They don't even know what they're buying. It just happens automatically every month. Family offices. So anyways, I still think we're waiting for debt ceiling. I still think we're waiting for the June Fed meeting. I think most capital, so I'll repeat myself from a couple of days ago. I think most capital's already been deployed based on your macroeconomic strategy. Some people right now think that a soft landing is the most likely outcome, and that any recession that does happen won't be that bad. Others think that the worst is coming and the inflation will not be addressed. Okay? Or the Fed has to continue raising interest rates. That's not priced in. And so the way I analyze a lot of these charts, and it's not just the S&P 500, many of these charts show the same thing, where bulls have bought exactly where a bull would buy and bears have sold exactly where a bear would sell. And now everyone's just waiting and there's no new money. And so anything moving up or down is more like hedges coming in and out of the market. Heather says, you're a bear on gold? Yeah, well, I'm disinflationary. A few days ago, you were saying gold going to... I did? I might have talked about someone else that made declarations like that. I'd have to see the context. Maybe I didn't say it well. But I've been positioning my entire portfolio for risk off, disinflationary type things, Heather. So I'm not sure what I said or referenced in that moment. I've been disinflationary for quite some time, actually. Yeah, like it doesn't even. Yeah, so it's regrettable, Heather. I'm sorry for that. I'm trying to think of, like, I can't think of a scenario where I would have said 3,000. Kyle says, the disinflationary side. Yeah. So I'm not sure when I would have said it. Trying to look at, I'm looking at the charts really like, Yeah, so I'm sorry, Heather, if I was misunderstood. I don't remember the scenario. I do remember somebody. I heard somebody on Bloomberg talk that way, but that doesn't mean I agree because I don't listen to anybody. I'm an only child. And I'm a male, so it's impossible for me to listen. So someone says it, but I don't know. Isaac says, well, if it takes out 2,100 and it holds, but even then, how would I come up with 3,000? Let me try to do it. Let me see if I can recreate it. So Heather, even if I was crazy bullish on gold, the highest the chart predicts is $2,291.50. So I'm not sure. Are you sure it was me, Heather? I usually don't do hyperbole like gold is going to go up 50%. I just don't, it doesn't sound like me, nor does it fit with what I'm actually doing. So I've been clear over the last several weeks, over the last 6 weeks, really. And now I'm really done. My portfolio is completely, really, 10 to 15 days ago. Anyways, I think I'm actually completely done repositioning my portfolio for real potential risk. I'm not, What would I have been talking about? Commodities, maybe. Peter Schiff is in the 3,000 band. Yeah, but he and I probably have nothing in common, right? Yeah. Well, I can't think of this, what I was talking about then. I don't remember making like a declaration that I'm a bull going for 3,000. The biggest, craziest thing I've said recently was Japanese yen versus the US dollar. Oh, it's not even here. Scan. Oh, wrong pivots. Guess it's here. Okay, the biggest one I've said here. Oh, look at that. Look, our trade worked. Sweet. Was going for 3,000 pips on this one. You can see right here is my target. If I can move that horizontal line. See the target? Peter says, yeah, maybe in 2050. Yeah, Coach, I believe you said if it went up, you would buy until 3,000 or something like that. I'll just... But you... for the sake of conversation. Well, okay, but I'm still trying to think of like what I was trying to say. I'm definitely not a bull on gold, and I haven't been for a very long time. So I'm trying to figure out the context of which I was saying, because then there might be an interesting point to it. Let me go back into here. But it's not, I'm in the disinflationary camp. I'm worried about the stock market falling. I'm buying the US dollar. You would never buy gold in a scenario like that, right? But I suppose if something had occurred differently, but I can't even think of what I would have said. I guess what the Fed pauses here. I guess here's the narrative then. The Fed pauses, the debt ceiling is addressed, the market turns bullish, a recession is averted. So the stock market rallies, but inflation stays high. I suppose the rampant inflation, unaddressable inflation. Yeah, okay, Heather. If it was like that, I could see that. I could see that narrative. So I suppose maybe what I wasn't clear on is we don't have that narrative now. We don't have that narrative now, but it could happen. So let's pull that chart up. And Darko says an exit zone. Well, it wasn't here, was it? So let's do... yeah, I forget where those X's were. Yeah, we are definitely in a profit-taking zone for bears. Okay? So Heather, yeah, I could see how I may have said something like that. One thing we don't know, I mean, we can guess. No, it wasn't this chart. It was a different chart, but it's similar because it's the same asset. But anyways, going back to Heather's thing. All right. We don't know what the future holds. We don't know how market participants are going to behave. We do know how they're positioned for the Fed. But we don't know like when the lagging effects of the economy is going to come in. So can we have a situation where we have a slowing economy and high inflation? Yes, that's stagflation. Now, stagflation is impossible without government manipulation. Have we had government what did I just say? Government intervention. So have we had government intervention recently? And of course, the answer to that is yes. So is that possible? Yes. So let's say we have a slowing economy, but not a tanking economy. So like commercial real estate becomes a problem, banking becomes a problem. So asset prices start coming down, but people don't really lose their jobs or something. Okay. So we're in a slowing economy, but the inflation doesn't go anywhere. And so we get down to 5%, but it sticks at 5%, stays there for a long time. All right. Could we have a narrative where you need to hedge that inflation with gold and with a shallow recession? Yeah. Okay. Yeah. In that situation, Heather, I could see how something like that, where would gold go from 2,000 to 3,000? Yes, but we don't have that yet. Okay? We don't have that yet. So I'm not a buyer of gold because I'm still in the disinflationary camp. Okay. Sky Killer says, Coach, do you have anything new to say about the IMF economic outlook in Asia and emerging markets? No, just it seems like many of them are slowing, that's all. Okay. Well, Sky Killer, we know like China, for example, is buying less steel, less copper, less metal, less of everything right now. So industrial production looks like it's pretty low. PMI is contractionary. So are they going to be relatively better? It doesn't look like it at the moment. So anyways, guys, going back to gold to 3,000, we don't have the narrative yet. And it really depends on what happens in this between now and the second half, in particular, most of the, let's say, fourth quarter. If fourth quarter is a rally, then yeah, gold goes up. The worst case scenario is the fourth quarter is not a rally. Then the answer to that is no. Okay. Now, Tidal Wave says, hey, looking more and more like the Feds will raise interest rates again. Yes, I agree with that. That would bring gold down. Okay, Heather? So going back to answering Heather's question, it is possible with a different narrative. The narrative right now is risk off. There's potential for a stock market decline. And asset prices come down more. And when you're talking about aggregate asset prices, it's including gold. Aggregate means everything. So if apartment buildings are falling, the stock market is falling, bond yields are falling, gold is falling. Okay. Now, if we don't quite get there, and between now and the fourth quarter is sort of like slightly down, mostly sideways, and then up at the end of the year, yeah, okay, much different narrative. Gold would go back above 2,000, making a higher high. 3,000 doesn't seem right. I must have just thrown out, like, I don't know, a number. Like, I don't know how 3,000 came up with, because I typically don't throw out numbers without analysis, right? I don't make things up. So I don't know the 3,000 part. It must have just been some, just up kind of, up or way up. But I can't see how I got above 2,300 on that number for this year. So you'd have to think several years ahead. So anyways, I hope that is helpful, Heather. But right now, I've positioned my whole entire portfolio of gold not going up. Okay. And I'm much more interested in the conversation than the call as well. So I hope that is better, because we all need to understand the narrative, right? Yeah, my pleasure. I don't like to be misunderstood. I really don't. Kyle says, is your plan still to hold the long dollar until September? Well, I got my stops at break even, so okay. So right now I'm in survival mode. I don't know jack. Okay. S&P 500 up at a profit-taking zone and is turning red. That should benefit me, my positions. Oh, look, I made 100 pips while doing this webinar. I was up 550. Now I'm up 670 pips. So I'm doing okay. Look at that. Made 100 pips doing a live stream. Cool. Well, I think that should be it then, huh? Hey, if you're a member of FX Bootcamp and you've upgraded your account to one of the live group memberships, then we're all meeting today. All of us, day traders and swing traders. We are gathering at 4 p.m. Kyle says, yeah, but you've been waiting. Yes, it's true. I created the trade plan on Sunday, took the trade plan on Tuesday, added to it on Wednesday. So I'm doing the job. Okay. But yeah, patience and discipline. That's all it is. What would you like, Sky Killer? Going to introduce something new? Emmanuel says, do you correlate your trades? Yeah, you have to. You're either correlating or you're hedging. What's the agenda? We typically start with fundamentals. Then we typically do some group work. And then we typically do some trade plan review. Huh? Cool. We have a lot of great fun. Last week was only 3 hours long. The week before, I think, was 4 hours long. They're pretty serious meetings. But there you go, huh? So I got a bounce, yo. It was real. Peace on earth. May the pips be with you. May your profits be above average. We talked about how the economic situations lead to different narratives for aggregate demand. We talked about, for the first time in 10 years, commercial real estate prices are falling. And I went through some of the basic math to show that we probably have a long ways to go. Prices have fallen by, let's say, in that case, by 20%. They probably have to fall by 60%, right? So maybe now is not the time to invest into commercial real estate. But there will be a time. So again, we looked at a price tag of 733 million with a net operating income of 50 million, occupancy rate of 91%, and assumable mortgage at 5% for 440 million. And we thought that rollover of the assumable mortgage is probably going to have to be significantly less than that. In particular, if occupancy rates fall and asset prices fall, then the 60% in which a bank is going to want to put in will be a lot less than 440 million. Therefore, the price needs to fall dramatically. So it might be a good property with nice net operating income, but even then, once you pay for your mortgage and assume the risk of holding an office building in your portfolio for the next 10 to 20 years, the price isn't quite right. And even if they dropped it all the way down to 570, you're probably still not interested. Cool, man. It's only money. Peace on earth. May the pips be with you. May your profits be above average.